Welcome to your Insurance News Roundup for May 4, 2026, your one-stop weekly briefing on the stories shaping the insurance industry. Insurance News Roundup. May 4, 2026. A comprehensive review of the week's most significant insurance industry developments. Warning disclaimer. Nothing contained in this report constitutes legal, medical, financial, or official advice of any kind. This content is news reporting and editorial commentary only. News is news. It is not legal advice, financial advice, or medical advice. Do not treat the following anecdotal stories as advice. Always consult a licensed professional for guidance specific to your situation. Table of contents. Berkshire Hathaway posts blockbuster Q1 2026 earnings. Insurance underwriting Soars. Subtopic 1A, insurance float hits $176.9 billion. What it means for the market. Cigna announces exit from ACA marketplace. 369,000 members affected. Subtopic 2A, the subsidy cliff. How expired enhanced premium tax credits are reshaping the ACA. India opens insurance sector to 100% foreign direct investment. Subtopic 3A, while IC's 20% cap remains strategic control of India's largest insurer. GEICO escalates war on no-fault fraud with multiple New York lawsuits. Cyber insurance market approaches critical inflection point. Subtopic 5A, Munich Re's Global Cyber Risk Survey. 9,500 respondents reveal alarming gaps. ACA marketplace in turmoil. Premiums spike, enrollment drops, new verification rules. Subtopic 6A, the One Big Beautiful Bill Act's impact on health coverage. Florida property insurance signs of relief as hurricane season approaches. Subtopic 7A, slide insurance Q1 profit jumps 51%. Citizens depopulation pays off. Workers' compensation reform sweeps across states. Fraud crackdowns intensify. Subtopic 8A, California's OBBBA 1,398 new felony tools against kickback schemes. InsurTech funding rebounds. Counterpart raises $50 million, Romley launches autonomous fleet coverage. Subtopic 9A, the rise of embedded insurance projected $722 billion GWP by 2030. Ryan Specialty and Commercial Lines E&S market momentum continues. One Berkshire Hathaway posts blockbuster Q1 2026 earnings. Insurance underwriting Soars. Berkshire Hathaway released its highly anticipated Q1 2026 earnings on May 2, 2026, and the results underscored the conglomerate's dominant position in the global insurance industry. Operating earnings climbed a robust 18% year-over-year to $11.346 billion, up from $9.641 billion in the prior year quarter, reflecting broad-based strength across Berkshire's insurance, railroad, and energy segments. The insurance underwriting segment was a particular standout, with earnings surging 28.5% to $1.717 billion compared to $1.336 billion a year earlier, a performance that signals sustained pricing discipline and favorable loss experience across GEICO, Berkshire Hathaway Primary Group, and the reinsurance divisions. Insurance investment income registered at $2.679 billion, benefiting from the elevated interest rate environment and Berkshire's characteristically conservative fixed income portfolio. Net earnings attributable to shareholders totaled $10.106 billion, or $7,027 per Class A share, more than doubling the $4.603 billion reported in Q1 2025, a swing driven substantially by improved investment results and realized gains on equity dispositions. Digging deeper into the investment picture, Berkshire reported $7.0 billion in unrealized investment losses during the quarter, reflecting mark-to-market pressure on the equity portfolio amid broader market volatility. However, these paper losses were partially offset by $5.8 billion in realized gains on sales, suggesting that Berkshire actively trimmed certain positions at opportune moments consistent with Warren Buffett's well-known approach of selling when valuations stretch. The net effect on the income statement highlights the lumpiness inherent in GAAP reporting for companies with massive equity portfolios, a point Buffett has repeatedly emphasized in his annual letters. Despite the unrealized losses, the underlying operating performance remained exceptionally strong. Investors and industry observers viewed the results as a clear vote of confidence in the property casualty insurance market's profitability trajectory. The quarter also demonstrated that Berkshire's diversified insurance platform spanning personal auto, commercial lines, specialty, and reinsurance provides resilience that few competitors can match. From a broader market perspective, Berkshire's blockbuster underwriting results carry significant implications for the property casualty industry as it navigates what many analysts describe as a transitional phase from hard to softening market conditions. As the largest single provider of catastrophe reinsurance capacity in the world, Berkshire's willingness to deploy capital at adequate returns effectively sets a floor on pricing in key segments. The company's growing insurance float, now at approximately $176.9 billion, ensures it will remain a dominant force in absorbing large and complex risks that other carriers are reluctant to write. With combined ratios improving and catastrophe losses in Q1 remaining manageable, Berkshire's results suggest that disciplined underwriters can continue generating attractive returns even as competition intensifies. The performance stands in contrast to carriers that are struggling with elevated loss costs and social inflation. For the broader market, the message is clear: scale, discipline, and investment acumen remain the winning formula in insurance. 1A insurance float hits $176.9 billion. What it means for the market. Berkshire Hathaway's insurance float reached approximately $176.9 billion at the end of Q1 2026, an increase of roughly $500 million from year-end 2025 and a figure that dwarfs virtually every other insurer in the world. Insurance float represents the funds held by an insurer between the time premiums are collected and claims are paid. In essence, it is money that belongs to policyholders but sits on the insurer's balance sheet, available for investment. For Berkshire, float has been the engine of compounding wealth for decades, as Buffett has consistently generated investment returns on float that exceed the modest cost of the underlying insurance liabilities. At $176.9 billion, this pool of investable capital exceeds the GDP of many nations and provides Berkshire with unparalleled financial flexibility to pursue large acquisitions, absorb catastrophic losses, or simply earn robust fixed income returns in the current interest rate environment. The $500 million sequential increase from year-end 2025, while modest relative to the total, signals continued organic growth in premium volume across GEICO, General Re, and the Berkshire Hathaway Reinsurance Group. Competitors simply cannot replicate this structural advantage. Most insurers operate with float pools that are a fraction of Berkshire's, limiting their investment leverage and risk absorption capacity. As the insurance industry enters a potentially softer pricing phase, Berkshire's cost-free float ensures the company can maintain profitability and opportunistically deploy capital when others are forced to retreat. Cigna announces exit from ACA marketplace, 369,000 members affected. The Cigna Group dropped a significant bombshell on April 30, 2026, announcing its decision to exit the individual health insurance marketplace commonly known as the Obamacare exchanges effective at the end of 2026, a move that will leave approximately 369,000 members across 11 states without their current coverage heading into 2027. The announcement came alongside Cigna's Q1 2026 earnings report, which showed net income of $1.7 billion, reinforcing that the exit is a strategic reallocation of resources rather than a response to financial distress. Individual marketplace enrollment had already dropped 17% year-over-year, falling from 446,000 to 369,000, as consumers grappled with rising premiums following the expiration of enhanced premium subsidies. Brian Evanko stated that the company is divesting certain assets to enable greater focus on its core strengths in employer-sponsored plans, Medicare Advantage, and Evernorth Health Services, the company's pharmacy benefit and health services arm. The Obamacare business, while meaningful in terms of affected lives, represented a small fraction of Cigna's 16.6 million total medical customers. The decision reflects a broader industry trend of carriers reevaluating the economics of ACA participation in a post-subsidy environment where adverse selection pressures and regulatory uncertainty are mounting. Cigna's exit arrives at a particularly turbulent moment for the ACA marketplace, as the individual insurance market contends with multiple headwinds simultaneously. The expiration of the enhanced premium tax credits originally introduced through the American Rescue Plan Act and extended by the Inflation Reduction Act removed a critical financial cushion that had made marketplace plans affordable for millions of moderate-income Americans. Without those subsidies, consumers in the 200%, 400% of federal poverty-level income range have seen premium increases of hundreds of dollars per month, pushing many to either downgrade their coverage, seek alternatives through short-term health plans, or drop coverage entirely. For Cigna, the calculus was straightforward. A shrinking risk pool with deteriorating member health status produces an unfavorable combined medical loss ratio that is difficult to correct through pricing alone. The company's leadership signaled that the capital and operational resources dedicated to individual marketplace plans would yield substantially higher returns if redirected to growth areas like specialty pharmacy, behavioral health, and digital health services. The exit also insulates Cigna from the regulatory whiplash that has characterized ACA markets in recent years, including shifting enrollment rules and state-level mandates. For the 369,000 affected members, the transition will be managed over the remainder of 2026, but the practical consequences are significant, particularly for individuals with chronic conditions who have established provider relationships through Cigna's networks. Consumer advocacy groups have raised concerns that Cigna's departure will reduce competition in already thin markets, potentially driving up premiums for remaining carriers and limiting consumer choice. In several of the 11 affected states, Cigna was one of only 2 or 3 insurers offering marketplace plans, meaning its exit could leave some counties with a single carrier or, in worst-case scenarios, no marketplace option at all. State insurance regulators are monitoring the situation closely and working with remaining carriers to ensure adequate coverage options are available during the 2027 open enrollment period. The broader trend of carrier exits from the ACA marketplace is not new. Similar waves occurred in 2017 and 2018, but the current cycle is particularly concerning because it coincides with the subsidy expiration, rising medical costs, and legislative changes that collectively threaten the financial viability of the individual market. Industry analysts expect additional carriers to announce similar strategic exits in the coming months as the full impact of the subsidy cliff becomes apparent in their actuarial projections. 2. The subsidy cliff: how expired enhanced premium tax credits are reshaping the ACA. The enhanced premium tax credits that were introduced under the American Rescue Plan Act in 2021 and subsequently extended through the Inflation Reduction Act expired at the end of 2025, triggering what health policy experts have termed the subsidy cliff, a sudden and dramatic increase in out-of-pocket premium costs for millions of ACA marketplace enrollees. In the months since expiration, enrollment has dropped by approximately 2 million people, a significant decline from the record of over 24 million enrollees achieved during the 2025 plan year when subsidies were fully in effect. The One Big Beautiful Bill Act compounded the disruption by adding pre-enrollment verification requirements for premium tax credit eligibility, effectively ending the automatic re-enrollment process that had streamlined coverage continuity for millions. Many consumers who remain enrolled have been forced to downgrade to plans with higher deductibles, narrower provider networks, and reduced prescription drug coverage, trading away benefits to keep monthly premiums manageable. To illustrate the individual impact, a 40-year-old earning $50,000 annually could see their monthly premium jump by several $100s compared to what they paid with enhanced subsidies, a cost increase that rivals a car payment. In response to this complexity, AI-powered enrollment tools and decision support platforms are emerging to help consumers navigate the bewildering array of plan options, subsidy calculations, and network restrictions. The subsidy cliff represents one of the most consequential shifts in U.S. health insurance policy in years, and its effects will ripple through carrier economics, hospital finances, and household budgets for years to come. 3. India opens insurance sector to 100% foreign direct investment. In one of the most significant insurance regulatory reforms globally in 2026, India officially notified on May 2, 2026, that it is opening its insurance sector to 100% foreign direct investment, FDI, under the automatic route, a sweeping liberalization that eliminates the prior cap of 74% foreign ownership and positions the country as one of the most accessible insurance markets in the developing world. The reform implements the provisions of the Sabka Bima Sabki Raksha Act, 2025, which was passed by the Indian Parliament in December 2025 after extensive consultations with industry stakeholders, regulators, and foreign governments. Reinsurance first, the insurance intermediary, reinsurance brokers, or agents, and third-party administrators were required as not relates the need for foreign promotion board clearance. However, it remains subject to compliance with the Insurance Act, 1938, and approval from the Insurance Regulatory and Development Authority of India, ensuring that prudential safeguards remain in place. Notification also stipulates that at least one on the chairperson, managing director, or CEO of any foreign-owned insurance entity must be a resident in India, and a provision designed to ensure governance and accountability. The reform is expected to unlock significant capital inflows from global insurance giants that have long viewed India's 1.4 billion person market as an enormous growth opportunity constrained by ownership limits. India's insurance penetration rate has historically lagged behind global averages, hovering around 4% GDP compared to 7% or higher in major markets like the United States, United Kingdom, and Japan. The low penetration rate represents a massive untapped opportunity. Hundreds of millions of Indians remain uninsured or underinsured, particularly in rural areas where awareness of insurance products is limited and distribution infrastructure is sparse. By allowing 100% foreign ownership, the Indian government is signaling that it wants global insurers to bring not just capital but also technology, product innovation, and best practices in underwriting and claims management. Companies like Allianz, AXA, Zurich, and Manulife, which have operated in India through joint ventures with domestic of the Indian insurance distribution ecosystem. For Indian consumers, the increased competition and capital infusion is expected to drive innovation in product design, pricing, and digital distribution channels. The international insurance community has responded with notable enthusiasm, with several major carriers and brokers reportedly accelerating their India expansion plans in the wake of the notification. The reform is particularly significant for the reinsurance market, where India has historically been reliant on a small number of domestic reinsurers and the government-backed General Insurance Corporation, GIC Re. With 100% FDI now permitted, global reinsurance leaders such as Swiss Re, Munich Re, and Hanover Re could deepen their Indian presence, improving capacity and pricing for Indian primary insurers seeking catastrophe and specialty reinsurance. The timing of the reform is strategically important, as India faces growing insurance challenges related to climate change, urbanization, and an aging population, all of which require substantial capital and expertise to address. Compliance with IRDAI regulations, including solvency requirements, policyholder protection rules, and anti-money laundering provisions, will remain mandatory regardless of ownership structure, ensuring that liberalization does not come at the expense of consumer protection. The reform represents a watershed moment for Indian insurance and is likely to serve as a template for other emerging markets considering similar liberalization measures. 3A While IC's 20% cap remains strategic control of India's largest insurer. While the broader Indian insurance sector has been opened to 100% foreign direct investment, the Life Insurance Corporation of India, LIC, retains a separate and significantly lower foreign investment cap of 20%. Reflecting the government's determination to maintain strategic control over the country's largest and most systemically important insurer. LIC operates under its own founding legislation, the Life Insurance Corporation Act, 1956, which grants it a unique legal status distinct from other insurance companies governed by the Insurance Act, 1938. With over 280 million individual policies in force and assets under management that represent a substantial share of India's total institutional investment pool, LIC plays a critical role not only in providing life insurance coverage but also in financing government debt and supporting capital markets through its massive bond and equity portfolios. The differentiated treatment reflects the Indian government's delicate balancing act, welcoming foreign capital and expertise into the broader insurance market while preserving sovereign control over an institution that is deeply intertwined with national financial stability and public savings mobilization. Other global insurers, by contrast, can now fully own their Indian ventures and compete aggressively for market share in life, general, and health insurance segments. The reform extending to intermediaries, brokers, corporate agents, and TPAs further broadens the competitive playing field, ensuring that the benefits of liberalization extend beyond direct insurance underwriting to encompass distribution and servicing. Collectively, The reforms are expected to boost overall insurance penetration in India, attract billions of dollars in foreign investment, and accelerate the modernization of an industry that serves the world's most populous nation. 4. GEICO escalates war on no-fault fraud with multiple New York lawsuits. GEICO has dramatically intensified its litigation campaign against no-fault insurance fraud in New York, filing a new $2.6 million lawsuit on April 30, 2026, that names 4 medical supply companies accused of operating a coordinated scheme involving paper owners, a hidden controller, and 4 shell suppliers that rotated in and out of operation to evade detection. The lawsuit alleges that the defendants submitted fraudulent claims for durable medical equipment, DME, that was either never delivered to patients, medically unnecessary, or prescribed by providers who had no legitimate treatment relationship with the claimants. This latest action follows a March 2026 lawsuit in which GEICO sued 12 separate DME companies, alleging more than $2.9 million in fraudulent billing, part of what the insurer describes as a systemic pattern of organized fraud that exploits New York's no-fault insurance system. The no-fault system, designed to ensure that auto accident victims receive prompt medical treatment regardless of who caused the accident, has long been criticized as a magnet for fraud because it requires insurers to pay claims quickly with limited ability to investigate before payment. GEICO's aggressive posture also builds on the landmark GEICO v. Patel RICO case, which was decided by the Second Circuit in 2026, where the insurer alleged $3.4 million in fraudulent reimbursement claims spanning 2019 to 2023, involving unnecessary treatments, kickbacks to patient recruiters, and forged patient signatures on treatment authorizations. The combined litigation effort represents one of the most aggressive anti-fraud campaigns by a single insurer in recent memory. The no-fault fraud problem in New York extends far beyond any single insurer's experience, representing a multi-billion-dollar drain on the auto insurance system that ultimately manifests in higher premiums for every driver in the state. Fraud networks operating in the no-fault space have become increasingly sophisticated, employing corporate structures specifically designed to frustrate law enforcement and regulatory investigations. The rotating shell company model alleged in GEICO's latest lawsuit is a prime example. When one entity attracts regulatory scrutiny or is flagged by an insurer's special investigations unit, it is shut down and replaced by a new entity with different nominal ownership but the same hidden controller, billing staff, and fraud infrastructure. The use of paper owners, individuals whose names appear on corporate filings but who have no actual role in the business, adds another layer of insulation, making it difficult for investigators to identify the true beneficiaries of the fraud. GEICO's decision to pursue civil RICO claims signals an escalation from traditional fraud-by-fraud litigation to a strategy aimed at dismantling entire criminal enterprises through broad conspiracy allegations. Insurers invest heavily in data analytics and special investigation unit capabilities, enabling it to identify patterns across thousands of claims that reveal coordinated fraudulent breadth of the problem. In Kentucky, insurance agent Glenn David Ramey pleaded not guilty to charges that he collected premiums from members of his church congregation and pocketed the funds instead of placing the coverage with an insurer, leaving his fellow churchgoers uninsured and exposed to potentially catastrophic losses. Meanwhile, in upstate New York, an insurance agent pleaded guilty to stealing more than $50 million in premiums, one of the largest individual agent fraud cases in recent history, in a scheme that allegedly spanned years and involved falsified policy documents, forged carrier correspondence, and systematic diversion of client funds. These cases underscore a persistent vulnerability in the insurance distribution system, the trust-based relationship between agents and policyholders, extended period, injury groups held for hand back requirements, more frequent audits of trust accounts, and digital payment systems that would eliminate the opportunity for agents to handle client funds directly. The aggregate cost of insurance fraud across all lines is estimated to exceed $80 billion annually in the United States, a staggering figure that translates directly into higher premiums for honest policyholders. 5. Cyber insurance market approaches critical inflection. Insurance in April 2026 warning global cyber insurance market is approaching pricing for a inflection point that could reshape the competitive landscape and risk return dynamics for years to come. According to Munich Re's estimates, the global cyber insurance market totaled nearly $15 billion in gross written premium in 2025, with projections indicating it will reach $28 billion by 2030, representing a compound annual growth rate of approximately 15%. However, sustained premium softening over the past 18 months, driven by new market entrants, expanded capacity, has compressed margins to levels that many underwriters view as unsustainable given the underlying risk profile. The threat landscape has not improved in tandem with pricing. Ransomware attacks, supply chain compromises, and state-sponsored intrusions continue to escalate in frequency and sophistication, creating a dangerous disconnect between what insurers are charging and the losses they may ultimately face. Dual's report outlines two potential paths forward: a gradual stabilization of pricing as insurers exercise greater discipline, or a continuation of the current softening trend that could set the stage for a severe market correction following a major systemic cyber event. The United States accounts for roughly 70% of global cyber gross written premium, making American insurers and insureds the most exposed to any repricing cycle. Data breaches and cloud service outages remain the most frequently reported cyber incidents, but the growing interconnectedness of digital infrastructure means that a single catastrophic event could trigger correlated losses across thousands of policies simultaneously. The convergence of softening prices and rising exposures has created a risk environment that many industry veterans describe as eerily reminiscent of the casualty market in the late 1990s, when years of competitive underpricing set the stage for the hard market that followed the September 11 attacks and the wave of asbestos liability verdicts. In cyber insurance, the equivalent catalytic event could be a widespread cloud infrastructure failure affecting multiple major providers, a coordinated nation-state attack on critical infrastructure, or a zero-day vulnerability in ubiquitous enterprise software that triggers simultaneous claims across industries and geographies. The challenge for cyber underwriters is that traditional actuarial methods built on decades of historical loss data and well-understood risk distributions are poorly suited to a peril where the threat landscape evolves continuously, attackers adapt to defenses in real time, and correlations between policies are difficult to quantify. Model uncertainty remains substantial, with different catastrophe models producing widely divergent estimates of probable maximum loss for the same portfolio. Some carriers have responded by tightening terms and conditions rather than raising headline rates, introducing sublimits for ransomware, adding waiting periods for system failure coverage, and requiring policyholders to demonstrate specific cybersecurity controls as conditions of coverage. Others have expanded their appetites, viewing the current pricing environment as an opportunity to gain market share before the inevitable correction. For corporate risk managers, the current cyber insurance market presents both opportunities and challenges. On one hand, the soft pricing environment means that organizations can obtain broader coverage at lower premiums than at any point since 2020, making it an attractive time to purchase or expand cyber insurance programs. On the other hand, the quality of coverage varies enormously across carriers, with significant differences in policy language, claims handling capabilities, and financial strength factors that only become apparent when a claim is actually filed. The 60% of C-level managers who expressed concern about cyber attacks affecting their companies, according to Munich Re's latest survey, represent only a fraction of the executive population that should be actively engaged in cyber risk governance. Small and medium-sized enterprises remain dramatically underinsured, with cyber insurance penetration rates in the SME segment estimated at less than 20% despite the fact that smaller organizations are disproportionately targeted by threat actors who view them as softer targets with fewer security resources. The gap between the insured and uninsured cyber risk in the global economy represents both a market opportunity for insurers and a systemic vulnerability for the digital economy. As the market approaches its pricing floor, the decisions that underwriters, brokers, and risk managers make in the coming 12 to 18 months will determine whether the cyber insurance industry emerges as a stabilizing force or becomes a source of financial instability in its own right. 5A Munich Re's Global Cyber Risk Survey: 9,500 respondents reveal alarming gaps. The fourth edition of Munich Re's Global Cyber Risk and Insurance Survey, released in early 2026, represents one of the most comprehensive assessments of corporate cyber risk preparedness ever conducted, with more than 9,500 respondents spanning 20 countries and virtually every major industry vertical. The survey's most sobering finding is that a rising majority of managers acknowledge that their company does not defend itself adequately against cyber threats, a gap between awareness and action that persists despite years of high-profile breaches and regulatory pressure. Concern about cyber threats is highest among respondents in the IT sector, 68%, followed by healthcare and pharmaceuticals, 64%, and finance, 63%. Industries where the combination of sensitive data, regulatory scrutiny, and operational dependency on digital systems creates an especially acute risk profile. Data breaches and cloud outages ranked as the most common cyber incidents, second only to broader business interruption events in terms of financial impact. The survey found that the ratio of malicious to non-malicious cyber insurance claims is approximately 3:1. Meaning that deliberate attacks by external threat actors or malicious insiders account for the vast majority of insured cyber losses, with accidental causes playing a secondary role. Ransomware remains the single most dominant driver of cyber insurance claims by severity, with average claim costs continuing to rise as attackers target larger organizations, exfiltrate data prior to encryption, and demand multi-million-dollar ransoms. Perhaps most alarming, AI-generated deepfake evidence is emerging as a new threat vector, with respondents reporting incidents in which fabricated audio, video, or documentary evidence was used to support fraudulent insurance claims or to manipulate business decisions. 6. ACA Marketplace in turmoil, premiums spike, enrollment drops, new verification rules. The Affordable Care Act marketplace is experiencing its most significant period of upheaval since the rocky early years of implementation, as the convergence of expired enhanced subsidies, new enrollment verification requirements, and carrier exits is creating a perfect storm of disruption for millions of Americans who depend on individual market coverage. The expiration of the enhanced premium tax credits at the end of 2025 has hit moderate-income enrollees particularly hard, with many seeing their monthly premiums double or even triple compared to what they paid during the subsidy-enhanced period. CMS took aggressive action in 2025 to address enrollment integrity concerns, canceling approximately 250,000 enrollments that were determined to have been made without consumer consent, a problem traced to aggressive broker marketing practices and unauthorized enrollment schemes. Subsequently, CMS restored plans for roughly 200,000 affected consumers who had been caught up in the cancellation process, and the agency estimated that its enrollment integrity efforts would save the federal government nearly $10 billion annually by eliminating fraudulent or unauthorized subsidy payments. New pre-enrollment verification rules now require consumers to demonstrate eligibility for premium tax credits before their coverage takes effect, replacing the previous system in which eligibility was verified after enrollment. These changes are designed to reduce fraud but have also created friction in the enrollment process, leading to delays and confusion for legitimate applicants. The employer-sponsored insurance market, while more stable than the individual market, is not immune to the broader cost pressures affecting healthcare coverage. Employer plans are projecting modest premium increases of 5 to 7% for 2026, driven primarily by rising pharmacy costs, particularly for GLP-1 receptor agonist drugs used for diabetes and weight management, and increased utilization of behavioral health services. A recent congressional hearing exposed significant gaps in Medicare fraud enforcement, with lawmakers criticizing the long-standing pay-and-chase model in which the government pays claims first and attempts to recover fraudulent payments after the fact. Witnesses testified that the pay-and-chase approach results in billions of dollars in unrecoverable losses annually, as fraudulent providers often dissolve their operations before recovery actions can be initiated. The hearing generated bipartisan support for shifting toward a prepayment verification model, though implementation challenges related to claims processing speed and provider burden remain significant. Meanwhile, findings from the Commonwealth Fund revealed entrenched racial and ethnic disparities in healthcare access and insurance coverage, with Black and Hispanic Americans significantly more likely to be uninsured or underinsured compared to white Americans. These disparities have widened in the wake of the subsidy expiration, as communities of color are disproportionately represented among the moderate-income population most affected by the loss of enhanced premium assistance. Looking ahead, the trajectory of the ACA marketplace will depend heavily on legislative action at both the federal and state levels. Several states have implemented or are considering state-level premium subsidies to partially offset the loss of enhanced federal credits, though the fiscal capacity to fully replace federal subsidies is limited. State-based exchanges have generally outperformed the federal marketplace in retaining enrollees, thanks to more robust outreach, navigator programs, and locally tailored marketing efforts. However, even the best-performing state exchanges are seeing enrollment declines that reflect the fundamental economics of coverage affordability without subsidies. The insurance industry is adapting with a mix of strategies. Some carriers are narrowing networks and raising deductibles to keep premiums competitive, while others are exiting markets where the risk pool has deteriorated beyond the point of profitability, as Cigna's decision illustrates. For consumers, the current environment demands careful plan selection, proactive engagement with enrollment assistance resources, and an understanding of the trade-offs between premium costs, out-of-pocket exposure, and provider access. The next 12 months will be critical in determining whether the ACA marketplace stabilizes at a new equilibrium or continues its downward spiral toward a market dominated by a small number of carriers serving an increasingly high-risk population. 6A The One Big Beautiful Bill Act's impact on health coverage. The One Big Beautiful Bill Act, OBBBA, signed into law on July 4, 2025, represents the most sweeping restructuring of federal health programs in over a decade, with far-reaching implications for Medicaid, Medicare, and the ACA marketplace that are only now beginning to manifest in real-world coverage outcomes. Among the law's most consequential provisions are new Medicaid work requirements that condition eligibility on documented employment, job training, or community service activities, requirements that health policy experts warn will result in substantial coverage losses among vulnerable populations who face barriers to meeting documentation requirements even if they are, in fact, working. The American Medical Association, AMA, estimates that approximately 11.8 million people will lose coverage as a direct result of the OBBBA's combined Medicaid changes, including restrictions on states' ability to use provider tax financing to draw down federal matching funds, a mechanism that many states have used to expand Medicaid eligibility beyond minimum federal requirements. The law also imposes pre-enrollment verification for premium tax credits, requiring applicants to submit income documentation and have their eligibility confirmed before coverage begins, replacing the previous post-enrollment verification process. On the Medicare side, the OBBBA includes a temporary 2.5% Medicare physician conversion factor update for 2026, partially reversing years of real dollar payment cuts that have driven growing numbers of physicians to limit or stop accepting Medicare patients. The law also includes provisions affecting medical student loans, linking certain loan forgiveness programs to practice in underserved areas, a policy aimed at addressing the physician workforce shortage but criticized by medical education advocates as insufficiently funded. Taken together, the OBBBA's health provisions represent a fundamental rebalancing of federal health policy priorities, with significant consequences that will unfold over years. 7. Florida property insurance signs of relief as hurricane season approaches. Florida homeowners are finally seeing meaningful relief in their property insurance costs after years of dramatic premium increases that made the state one of the most expensive places in the nation to insure a home. Citizens Property Insurance Corporation, the state-run insurer of last resort, is implementing an average rate reduction of 8.7% statewide for 2026, with particularly significant decreases in South Florida. Broward County policyholders are seeing an average 14.1% reduction, while Miami-Dade County residents are benefiting from a 13.9% decrease. The rate reductions are driven by a combination of improved loss experience, lower reinsurance costs, and the success of Florida's depopulation programs in transferring policies from Citizens to private carriers. Citizens' policy count has declined dramatically from a peak of approximately 1.4 million policies in 2023 to around 396,000 currently, a remarkable transformation that reflects the return of private capital to the Florida property insurance market. Private carriers have followed Citizens' lead, with several announcing rate decreases in the 5 to 11% range, signaling that the competitive dynamics in the market have shifted from desperation-era crisis pricing to a more normalized environment. Despite the positive trend, Florida property insurance remains expensive by national standards, with average annual premiums ranging from $3,800 to more than $5,800 depending on location, construction type, proximity to the coast, and wind mitigation features. The approaching 2026 hurricane season adds an element of uncertainty, while Colorado State University's seasonal forecast projects slightly below average activity. Even a single landfalling major hurricane could reverse the pricing gains overnight. Several market innovations are emerging that could further reshape the Florida property insurance landscape. Two new tarp and flood protection products have been introduced by Florida-based firms, designed to provide immediate post-storm protection for damaged roofs and interiors, addressing a long-standing gap in the market where homeowners often suffer secondary water damage while waiting for permanent repairs. Citizens Property Insurance is also implementing new requirements for policyholders with homes valued at $400,000 or more in replacement cost, mandating that they purchase separate flood insurance cover as a condition of maintaining their Citizens wind policy. This requirement reflects a growing recognition that wind and flood risks are increasingly intertwined in Florida. Many hurricane losses involve both wind-driven structural damage and storm surge or rainfall-induced flooding, and traditional property policies exclude flood damage, leaving homeowners with unexpected coverage gaps. The National Flood Insurance Program, NFIP, and a growing number of private flood insurers are competing to serve this market, with private carriers often offering lower premiums and higher coverage limits than the NFIP's Risk Rating 2.0 pricing methodology produces. For insurance agents in Florida, the evolving landscape presents both challenges and opportunities. Consumers need more guidance than ever in navigating the complex interplay between wind, flood, and supplemental coverage options. Wind mitigation inspections and credits remain one of the most effective tools for reducing premiums, with homeowners who have installed impact-resistant windows, reinforced roof decking, and secondary water barriers eligible for discounts of 30 to 50% on the wind portion of their premium. The broader policy reforms enacted by the Florida legislature in recent years have been instrumental in creating the conditions for the current market improvement. Senate Bill 2A, passed during a special legislative session in late 2022, and subsequent reform legislation in 2023, imposed significant restrictions on assignment of benefits abuse and attorney fee multipliers, two practices that had driven an explosion of litigation costs that were unique to Florida and made the state an outlier in property insurance loss ratios. The litigation reforms have dramatically reduced the volume of property insurance lawsuits filed in the state, removing a major source of loss cost uncertainty that had driven carriers to either exit Florida entirely or raise premiums to levels that many homeowners could not afford. The reforms also created incentives for carriers to enter or re-enter the Florida market, and the Office of Insurance Regulation has approved over a dozen new carriers since the reforms took effect. Reinsurance costs for Florida-focused carriers have declined as reinsurers have gained confidence that the reformed legal environment will produce more predictable loss outcomes. The combination of legislative reform, depopulation success, reinsurance cost reduction, and a recent stretch of below-average hurricane activity has created a virtuous cycle that is slowly restoring confidence and competition to a market that was on the brink of collapse just 3 years ago. However, stakeholders caution that sustained improvement depends on continued legislative discipline and, inevitably, on the path of future hurricane seasons. 7A Slide Insurance Q1 profit jumps 51%, Citizens depopulation pays off. Slide Insurance delivered an impressive Q1 2026 performance, with profits surging 51% compared to the prior year quarter, underscoring the financial opportunity that Citizens property insurance depopulation programs have created for well-capitalized private carriers willing to take on Florida homeowners' risk. The company's policies in force grew 46% year-over-year, driven primarily by the absorption of policies from Citizens through the state's managed depopulation process, which allows private carriers to assume blocks of Citizens policies that meet their underwriting criteria. Slide's results are emblematic of a broader trend in the Florida market. The dramatic reduction in Citizens policy count from 1.4 million to approximately 396,000 has not simply shifted risk from the public to the private sector, it has created profitable underwriting opportunities for carriers that bring modern technology, sophisticated catastrophe modeling, and disciplined pricing to the table. The market transformation is remarkable by any standard. In the span of roughly 3 years, the Florida property insurance market has gone from existential crisis, with Citizens growing uncontrollably and private carriers fleeing, to a competitive environment where multiple private carriers are actively seeking to write homeowners' business. Insurance reforms limiting frivolous litigation, particularly the restrictions on one-way attorney fee provisions and assignment of benefits abuse, have been a critical enabler of this transformation, as they have reduced the litigation drag that previously made Florida homeowners' policies unprofitable regardless of hurricane activity. Homeowners can further reduce their premium burden through wind mitigation credits, which reward investments in impact-resistant construction features with premium discounts of 30 to 50% on the wind portion of the policy. Independent insurance agents play a key role in helping Florida consumers navigate the transition from Citizens to private carriers, comparing coverage options, identifying mitigation opportunities, and ensuring that policyholders maintain adequate protection as they move into the private market. 8 Workers' compensation reform sweeps across states. Fraud crackdowns intensify. Workers' compensation insurance is undergoing a wave of reform and enforcement activity across multiple states, as legislatures, regulators, and law enforcement agencies step up efforts to combat fraud, modernize claims processes, and ensure that injured workers receive the benefits they are entitled to without delay. In California, the Workers' Compensation Insurance Rating Bureau, USIRB, submitted a September 1, 2026, pure premium rate filing of 10.4%, reflecting the Bureau's analysis of loss trends, medical cost inflation, and frequency patterns across the state's diverse industry mix. California's legislative efforts have been equally active, with AB 1398 strengthening felony prosecution tools for kickback enforcement in workers' compensation, a law specifically designed to target the pay-to-play networks that channel injured workers to specific medical providers in exchange for illegal referral fees. On the East Coast, New York Governor Kathy Hochul's 2026 budget proposal includes $17 million in dedicated funding for district attorney workers' compensation fraud units, a significant investment that reflects the scale of the problem in the nation's third-largest workers' comp market. Workers' compensation claims fraud costs the American economy an estimated $35 to $44 billion annually, a figure that encompasses fraudulent claims by employees, providers, and employers who underreport payroll to reduce premium obligations. California has allocated $8.55 million in fiscal year 2025 for local prosecutor enforcement grants, while New York reported uncovering $2.7 million in fraud and making 14 arrests, a 30% increase over the prior year through its workers' comp fraud investigation programs. The human cost of workers' compensation fraud extends beyond the financial losses to insurers and employers. It undermines the system's ability to deliver timely, appropriate care to workers who are legitimately injured on the job. Fraudulent provider schemes, in particular, often result in injured workers receiving unnecessary or inappropriate medical treatment, delayed return-to-work outcomes, and extended periods of disability that compromise their long-term physical recovery and economic security. The New Jersey court system provided a dramatic illustration of the stakes involved when a jury awarded $5.2 million to an accident victim in a case that highlighted both the severity of workplace injuries and the importance of adequate compensation for workers who suffer life-altering harm. Across the industry, there is a growing recognition that modernizing the workers' compensation claims process is essential to reducing fraud, improving outcomes, and controlling costs. Telemedicine is playing an increasingly important role in initial injury triage care, enabling insurers to access medical more quickly, using the opportunity to provide insert themselves as predictive analytics models are being developed to identify suspicious claims patterns at the point of first report, allowing special units to intervene early or campaigns are made. The shift toward data-driven fraud detection represents a fundamental change from the traditional reactive model, in which fraud was typically identified only after substantial losses had been incurred. The enforcement landscape is evolving rapidly, with both state and federal authorities signaling a more aggressive posture toward workers' compensation fraud networks. The Department of Justice's Task Force KleptoComp has signaled a multi-district RICO indictments targeting organized fraud rings that operate across state lines, coordinating fraudulent claims through networks of corrupt providers, employers, and claimant enterprises that mirror the organizational structure of other forms of organized crime. At the state level, California's AB 1398 addresses a specific vulnerability in the existing legal framework by clarifying referral fee disclosure requirements and making it easier for prosecutors to bring felony charges against individuals who conceal financial interests in workers' compensation referral arrangements. Previously, some kickback schemes operated in gray areas where the legal distinction between legitimate marketing fees and illegal kickbacks was unclear, allowing participants to argue that their conduct fell within permissible boundaries. Technological innovation is also playing a role in fraud prevention, Texas Mutual is piloting blockchain-based claim ledgers that create immutable records of every transaction in the claims process, making it far more difficult to alter medical records or billing data after the fact. Real-time payroll verification APIs are emerging that allow insurers to validate employer payroll data against tax records instantaneously, eliminating the payroll underreporting that has long been one of the most common forms of employer-side workers' comp fraud. 8. California's OBBBA 1,398 new felony tools against kickback schemes. California Assembly Bill 1,398 represents a targeted and significant enhancement of the state's ability to prosecute kickback schemes in the workers' compensation system, addressing a gap in the existing legal framework that had allowed some fraudulent referral arrangements to operate with relative impunity. The law clarifies referral fee disclosure requirements, imposing explicit obligations on medical providers, attorneys, and intermediaries to disclose any financial relationships that could influence the referral of injured workers for treatment or legal representation. More importantly, OBBBA 1,398 makes it substantially easier for prosecutors to pursue felony charges against individuals who conceal financial interests in workers' compensation referral arrangements, removing ambiguities in prior law that defense attorneys had successfully exploited to reduce charges or secure acquittals. The law is particularly important for protecting workers who disproportionately OBBBA 1,398 targets the pay plan works that Cigna referral providers linked to state scheme, creating a rank of that could participant works operating in neighboring states. On the technology front, innovations like the blockchain claim ledgers being piloted by Texas Mutual and real-time payroll verification APIs represent the next frontier in fraud prevention, creating digital audit trails and for fraudulent protected. Counterpart raises $50 million coverage. InsurTech sector is and strategic partnerships signaling that the post-2021 correction has given way to a more mature and focused phase of innovation. Counterpart, a managing general agent specializing in AI-era business risk, raised $50 million in a Series C funding round to expand its agentic insurance platform, which uses artificial intelligence to associated with companies that deploy AI systems, a fast-growing area of liability that traditional carriers have been slow to address. In the mobility sector, Romley launched usage-based commercial insurance specifically designed for autonomous fleets, including vehicles equipped with FX data, route risk made way into with a single appointment process collaborated on a digital disability insurance product aimed at freelancers and gig economy workers, addressing a significant coverage gap in the European market. The funding landscape for InsurTech has stabilized at approximately $4.8 billion in annual investment, a significant decline from the 2021 peak of $15.8 billion, but a level that reflects more disciplined capital allocation and a focus on companies with viable paths to profitability rather than pure growth metrics. Of the more than 58 InsurTech unicorns that existed, approximately 12 remain, with rest having been acquired, downgraded in subsequent funding rounds, or in some cases, entirely. And now focused on insurance provision, raised $2.5 million illustrating state funding remains able to address specific market news with differentiated supermarket. The UK-based price comparison powered application to include home and pet insurance quotes alongside its existing auto insurance functionality, demonstrating the growing role of conversational AI in consumer insurance shopping. The defining narrative of InsurTech in 2026 has shifted decisively from disrupting traditional carriers to enabling the most successful companies that have built technology platforms, data capabilities, or distribution channels that traditional insurers want to partner rather than compete against. This maturation is evident in being announced, partnerships, technology and intelligent arrangements and integration within the existing insurance domain. The era of company attempting to race in the case with fully vertically integrated alternative largely fast, released by more practical collaboration and digitalization. Several thematics are shaping tech and innovation orders in 2026. Autonomous vehicle ecosystem is a major area, as the proliferation of advanced driver assistance systems, ADAS, and the gradual deployment of fully autonomous vehicles create new insurance needs that traditional auto policies were not designed to address. Romley's autonomous fleet product is a prime example, but other InsurTechs are also developing products between internal log covering commercial fleet companies running autonomous or autonomous vehicles. Their space to attract business with products that based on predefined earthquake magnitude, rainfall totals, or power outage duration without the need for traditional climate-related InsurTech is another active area, with companies developing micro-insurance for agricultural needs in developed markets, satellite-based index insurance, and real-time weather management tools for critical clients. Global InsurTech investment may return to the head levels of 2021. The current rigorous underwriting of both insurance risk and investment risk is producing companies that are better capitalized, more operationally disciplined, and more closely aligned with the actual needs of the insurance industry. The matter of InsurTech ultimate development for the modern insurance ecosystem, as it translates innovation, practical improvements in underwriting accuracy, claims efficiency, and customer experience. The rise of insurance projected $722 GWP by 2030. And the integration of insurance coverage directly into the purchase of a product or services that grow the goal in the InsurTech ecosystem, with integration estimating that insurance could generate $722 billion written premium globally by 2030. Mid partnership in Europe, the Mac examined when consumer purchases electrical insurance offered seamlessly as part of with a policy based on the vehicle specifications, the buyer's profile, and telematics data from the vehicle's onboard systems. This model eliminates the traditional friction of the insurance buying process. Consumers do not need to independently shop for quotes or navigate the policies. The insurance is embedded within a enterprise enablement is the defining InsurTech narrative of 2026. The most valuable InsurTech companies are not those that compete head-to-head with incumbent insurers but rather those that provide the technology infrastructure that allows insurance to be distributed through any digital channel. Lemonade, one of the most prominent consumer-facing InsurTechs, has reached approximately $750 million in in-force premium, a significant milestone, but continues to struggle with GAAP profitability, illustrating the challenge of building a full-stack insurance carrier in competition with incumbents who have decades of underwriting data and established distribution networks. The embedded insurance model sidesteps this challenge entirely by partnering with existing carriers for risk-bearing capacity while focusing on the technology, data, and user experience layers that drive distribution efficiency. 10 Ryan Specialty and Commercial Lines E&S market momentum continues. Ryan Specialty Holdings delivered a strong Q1 2026 performance that reinforced the company's position as one of the premier wholesale distribution and specialty insurance platforms in the market. Revenue grew 15.2% year-over-year to $795.2 million, handily beating Wall Street consensus estimates and demonstrating the continued demand for specialty and excess and surplus (E&S) lines placement expertise. Organic revenue growth, which strips out the impact of acquisitions and provides a cleaner measure of underlying business momentum, was 11.8%, a rate that reflects both market-driven premium increases in E&S lines and Ryan's success in gaining market share from competitors. Net income for the quarter was $40.6 million, or 13 cents per diluted share, while the company's preferred profitability metric, adjusted EBITDA, grew 15.7% to $232 million, reflecting operating leverage as revenue growth outpaced expense growth. Ryan Specialty returned $64.8 million to shareholders during the quarter through share repurchases and dividends, signaling management confidence in the stability of the cash generation. The asset continues to market as admitted for rapid risks. This is net coverage for hard-to-place exposures. Broader lens features lending is carried by the risk and specialty segment and modest premium increases in commercial lines. MSIG USA, a subsidiary of MS&AD Insurance Group, named Patrick Doherty to lead its surety operation, bringing an A+ financial strength rating and expanded capacity to a surety market that has seen increased demand from infrastructure projects funded by the federal infrastructure law. CNO Financial Group reporting earned 30% in mental health Kansas City to the private areas to long-term inflation full systems in commercial risk management. These diverse results from wholesale distribution to surety, supplemental health, life insurance, and fire protection illustrate the breadth and complexity of the commercial insurance ecosystem. The sustained momentum in the E&S market reflects structural factors that exist beyond exposures are also disproportionately flowing into the E&S market. Expertise and appetite to underwrite exposures for wholesale specialty. This dynamic creates a environment and more risk flows into the E&S channel, the value of their market access, underwriting relationships, and placement expertise increases correspondingly. The competitive moat around established specialty distributors is significant, building the carrier relationships, technical underwriting knowledge, and proprietary data required to compete effectively in wholesale distribution takes years, creating high barriers to entry that protect incumbents. Looking ahead, the commercial insurance market is expected to see growth in specialty and NS segments, moderate increases in standard commercial lines, and ongoing investment in technology to improve underwriting efficiency and